So we're going to go over this because I can guarantee you nobody would have caught this, guaranteed, and I can guarantee you've never heard what I'm going to say, ever, and you never will. Because, of course, as you all know, I'm one of the top investment professionals in the world. That's confirmed, fact guaranteed. And I just have to say that for those who don't know, because they're not going to expect somebody like myself to be exposing these little YouTube minions and scoundrels. But, you know, somebody's got to do it. Somebody has to do it. Someone has to think of the public good rather than filling their pockets full of money, which is what my peers would be doing. And I'm just now starting to look at these guys' videos. I mean, honestly, folks, if I spend time watching videos of these various fake investment gurus, oh my God. I mean, I will just completely steamroll them into the ground. In this video, Paul is basically saying you can't forecast the market. Okay? So I'm going to explain something here that I can guarantee that nobody else would have ever have caught. You see? And this is a very common thing. And of course, Paul is going to give you this pitch that is basically from Wall Street, although he's never worked on Wall Street. And the pitch is basically, you can't time the market. Just dollar cost average, right? And I'm going to explain to you a few things, and you're going to learn a lot from this. And if you ever hear anyone mention this in the way that I'm explaining it, you'll know that they copied it from me. Because I can guarantee you, no one's ever discussed this in the world. Let's go ahead and listen to this video now. I want you to get a handle on what the genius is going to say, Mr. ShamWow.
Many would say that we are currently in a recession or one is very imminent. Do I know? I have no idea. What I'm here to do is to tell you to remain calm. Difficult? Absolutely. It's very hard. That's why we have the community of over 6,000 people who sit there and talk to each other and say, remember, it's about the long term. So let me show you how stocks have done since 1980 in the recessions. Remember, a recession happens every 4, 5, 6 years and lasts about a year and a half, a little bit less than a year and a half. So the question becomes, is you're going to let that year and a half affect your entire retirement, or are you going to take advantage of that and make it grow for you? So,
first of all, let me just go ahead and say, you can never count on historical data for certain, right? You never know what's going to happen. In fact, if you look at the stagflation period of the 70s, and I think maybe even early 80s, you can just take a look. It was up and down, up and down, up and down. Well, maybe we'll take a look of a chart here a little bit later. And so you can't rely on that. And if you think you can rely on that, why don't you ask the Japanese? Ask the Japanese people who were on top of the world back in the late 80s. The Nikkei peaked out, and it has come nowhere near to the highs that it was some 35, close to 35 years ago, right? So let's go ahead and just continue here and see what Paul has to say. He's going to show us some different market periods here.
remember one thing. This is the stock market. This is how it's going to go over time in terms of value. But here's how the prices actually happen. If you've watched our videos, I've done this 1,000 times. Your job's a dollar cost average all along the way. Like clockwork, no matter what the stock market's doing. You're going to overpay sometimes, and you're going to underpay. But over long periods of time, you're going to average exactly the stock market's value. So you're going to match the stock market. You're not going to try to be one of those people who buys actively managed mutual funds foolishly based on the last 2 or 3 year returns and realize that an ETF will do better over the long run. So
okay, so did you hear that, folks? What did he just make a case for? He's basically saying buy an index fund without realizing it, because that's how stupid he is. Hey, Paul, you just delegitimized your whole 8 pillars garbage without even showing us it's garbage, right? You see, he made the case buying an index fund. He doesn't even realize it. Paul, why don't you tell people, therefore, Just buy an index fund. You don't need to pay overpriced $30 a month for our garbage. In fact, folks, I wouldn't take it for free, because what you need to focus on is how much money you're going to lose using some nonsense like that. Think about it. He just made the case, and it makes sense, sure. Why? I don't want a dollar cost. I don't want to have to worry about, I'll just buy the index. That's all. And forget about it, right? You see, he's too dense to even realize that he just made the case for buying an index. We're just beginning, by the way. We're just beginning. Let's continue.
Pull up a recession from 1980. Now, guys, in the early 80s, we basically had 2 recessions within the first 2 or 3 years. So I'm just merging it into one. This is the S&P chart then. Around 140 here, and around 103 here. Guys, the current S&P is 4,000, and that's after falling from 4,900. It's just this year. You'd have paid an average of 120 if you just bought all along the way like you're supposed to. Just every month, bought the same amount. Would you have been happy buying at 120 and waking up 40 years later to 4,000?
What? Did you hear that? So Paul, let's take a look at a chart here. So the point I'm trying to make, by the way, is that he's saying, well, you should have dollar cost average in the 80s. And if you did that, 40 years later, wow, you'd see the market so high. 40 years? Like, hey, Paul, what if the person during that time in the 80s was 65? Well, it was a several-year period of stagflation. Are you going to keep putting money in the market if it's going down and down year after year after year after year? Of course you're not going to do that. Especially when Paul tells you that the average bear market lasts a year and a half. You're going to throw in the towel. There's so many ways to chew up this argument. See, Paul is going back and looking at the past and playing Monday morning quarterback, similar to what Mo did with his Alibaba trade, right? Monday morning quarterback.
Early 2000s, 9/11 happened. This is the big one. This is the dot-com. So this is not only a recession, but also the dot-com crash happened. S&P at 1,500, trough down here around 700. Let's call it 700 or so, 750.
Now this was a period, by the way,
7.
of about more than 3 years. More than 3. Started officially in March, I believe, of 2000, and the market bottom was made, I don't know, maybe it was late 2002 or 2003, early. You can take a look at a chart, right? And I lived through that period. I can tell you right now, first of all, people weren't putting a whole lot of money in the market. When they were, they got blown out early on. Ask yourself, who has money to keep putting into the market when you're in a severe recession, right? And ask yourself, who has the money to put into a market after it's going down? Most people are invested in the market fully. When it goes down, they don't have money to put in the market. That's the reason why forecasting is essential. I'll get into that a little bit later, but I've just given you a little quick segue into that.
50. That's falling in half, guys. If you bought all along the way, you'd have averaged around 1,100, right? Would you have been happy paying 1,100 12 years ago on the S&P when it's currently at 4,000? Almost 4 times your money plus dividends along the way. Do you see my point? Let's go to another recession. The Great Recession of 2007 to 2009. Look at this one, guys. We hit a peak about 1,550 and a trough of 666 on March 9th, 2009. That's a huge drop, 60% drop. What is this? Something like almost 60% drop. And guess what? S&P, just 12 years later, 13 years later, is at 4,000.
Problem is that he's looking at many years later. How about if you were retired when the peak hit in October 2007? You understand, folks? So the whole point he's basically saying is just keep buying, dollar cost average, keep buying all the way down. Well, what if instead you obtain access to superior research that forecasts the market based upon macroeconomics, valuation analysis, and other factors, and including, by the way, business and economic cycles, and you determine that right up around here, the risk is increasing, and you need to allocate some stocks into cash, right? You understand? You're going to have cash to buy down here. Of course, you're not going to time it exactly like I did, March 9th, 2009, right? But you don't need to time it exactly. If you are close, if you realize you're towards the end of a bull market, you change the allocation. You see, in the middle of a bull market is when you should be maximally invested. Towards the later stages of a bull market, you're starting to raise cash. You see, right? You all understand that? So let's move on.
You'd have paid an average of $1,100 again, 4 times your money in 12 or 13 years. I think you see my point here, guys. The point here is your job is to stay focused and stay strong. Now, just remember, is that easy? No. But that's why we have all these tools. That's why we have this community. This is where people go to talk and get themselves controlled, get themselves to not listen to noise, to get like-minded people that...
Folks, by the way, write this down as one of my rules, one of my many rules I've told you guys about, and if you've forgotten, you can ask me about some of them. Whenever somebody says like-minded, run for the hills. Like-minded. Come to our community of like-minded people. What that means is that brainwashing, cult formation. You need to think like us. We're all thinking the same. We're all absorbing the same ideas. No outside thoughts. Like-minded people. It's I believe, a undercover term for brainwashing. You don't want to be around a community of like-minded people. You want to be around a community of inquisitive people who have an open discourse and discussion. You see? And you're not ever going to get that in a Discord. Discords have specifically been created to sequester people, to brainwash people for cult formation, similar to private Facebook groups and similar types of forums.
That speak this way day in and day out. It is not easy, but for those who conquer it, for those who even just do better than the average person, you will crush it.
So Paul is saying, listen, come to our Discord. We'll keep you grounded. Wait a second, Paul. In the beginning, you just told us what we need to do. Just buy an index and forget about it. I don't need to go to your Discord. I don't need to pay any money. Just buy an index fund, right?
Because you won't try to buy in and out of the market at the wrong times. Because guess what? I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
Wrong. I am. I am, Paul. Speak for yourself. Okay? Speak for yourself. I'm a great market timer. I'm not perfect, but I'm probably the best in the world. I'm certainly one of the best. Speak for yourself. And you know what? You don't have to be a good market timer. You can be a decent market timer if you do what I just mentioned earlier. Factor in when the risk's increasing and raise cash. Okay? Speak for yourself, Paul. And we're going to get to market time. By the way, market timing, when someone says you're timing the market, that's a misnomer. And that was created as a way to, it's kind of like when politicians want to, in America, they want to turn people off to universal health care. They call it socialized medicine, you see. So they give it the inappropriate term to make it sound bad. Nobody times the market. You think people take a look at a watch and they say, oh, it's 3 o'clock, it's time to get into the market. That's not what people do. That's not what professionals do. Okay? Now, granted, most people actually can't time the market and shouldn't time the market. No doubt about that. It's very difficult to do, and it's extremely difficult to do on a pretty consistent basis fairly well. No doubt about it. But don't ever say no one is a good market timer. That's a lie. That's the myth. I'm not the only one that can do it. There's plenty of others that can do it as well. You just don't know about them because your heroes are has-been investors like Warren Buffett and Charlie Munger. They've been out of the picture for 20 years. He's saying no one can time the market, right? What do you think he's trying to do with his 8 pillars nonsense? He's trying to locate, identify stocks that are undervalued. Tell me that's not timing the market, right? If you understand market forecasting, it has nothing to do with timing the market. It has to do with economic forecasting, valuation analysis, and many other things. So when you're actually looking to shift into cash at the top, hopefully, and start deploying that cash back into the market towards the bottom, you're not just doing it based upon looking at a watch or an impulse. It's done based upon a complex series of analyses, including valuation analysis, many things. Okay? Many things. So isn't this what Paul is doing? He's trying to find undervalued securities. He's doing the same thing on an individual level, incompetently though, as someone who tries to forecast the market or so-called time the market. He's doing the exact same thing. And in fact, by saying that no one can time the market, that's advocating the efficient market hypothesis, which says that you can't determine when stocks are undervalued. The market pricing determines that. And in fact, the efficient market hypothesis invalidates value investing. Did you all know any of this? It's all fact. Write it down. Look it up. So he doesn't even know what he's talking about. He's confused. Now, Paul is a guy, he got an undergrad degree in, I don't know, economics or finance, right? I know a lot more than he does. I never took a finance course. I know a lot more than a lot of these guys that have spent all their years studying this stuff. You know why, folks? Because I've been in the markets. I didn't learn in a textbook. I learned in real life. He's flip-flopping back and forth. He makes a case in the beginning that basically, he doesn't say it, but he basically makes the case of you just should buy an index because he says you should dollar cost average the whole time so that you mirror the performance of an index. Well, why not just buy the index, right? And then he says, well, you can't time the market. Timing the market is based upon identifying good and bad periods of a basket of stocks, right, the market, based upon valuation analysis, which is also based upon many macroeconomic variables and other things, which I'm not going to get into. He's doing the same thing. He's trying to create some type of valuation analysis on individual stocks. You understand, folks? He's claiming that you can't time the market. He can't, but he's trying to do it on a daily basis when he puts his little stocks into this 8-pillar nonsense. Yes, efficient market hypothesis is a joke. I saw that 20 years ago, and I couldn't believe that. That's when I realized that there's nothing but sheep in the investment world, business, finance, economics world, especially business, economics, finance, because that garbage came from academia. Okay, that came from academia. At least in Wall Street, there's a variety of funds and strategies that don't even pay attention to that. And you'll notice the EMH, the efficient market hypothesis, has been continuously, year after year, they keep revising it and revising it and revising it closer and closer to basically trying to reword it because it's such a joke. So, yes, Tommy, when I nailed the exact bottom of the financial crisis, was there some luck involved? Yeah, there was some luck involved, but given the fact that I wrote about Dow 6500 in a book a year and a half earlier and mentioned it again in 2008 in some articles, I don't think it was a whole lot of luck. So, and I've been doing this quite successfully for quite some time. I'm not perfect. You don't need to be perfect. All you need to do is to be about, I would say, 60% is sufficient. I would say 70% is really good, and 80% is pretty amazing. And above that is phenomenal, I would say. Okay? But it's not just picking and choosing when to get out of the market and get into the market. And you don't get out and get in. You do it in steps, stepwise, based upon the amount of risk, based upon ongoing things. You see? So the main point I wanted to make is that Paul actually made a case early on in this video for basically just buying an index fund without even realizing it. And the second point is that he's actually involved. Anyone out there who's actually trying to analyze a security in order to gain some type of an edge, to find something undervalued, is in fact doing the exact same thing that individuals do that are forecasting the stock market, that are so-called timing the market. It's just that the people doing the market forecasting or timing, it's much more complicated and much more involved because you're dealing with an entire stock market. Most people can't and most people shouldn't try to time the stock market for a variety of reasons, okay? But the question is this. The question is, however, should people look at rising risk and maybe shift their portfolio a little bit to cash when risk is increasing? Say, for instance, when Russia started invading Ukraine, maybe people said, you know what, I'm gonna raise some cash. And just like, during this period, the market's gone down, depending upon the index, 20 to 30%. Okay, we don't know where the bottom is. Going to start to buy back in a little bit here and there, right? I don't think there's anything wrong with that. Now, that's even difficult for the typical investor. I think that it requires a pretty experienced investor who's level-headed, right? The bottom line is this. The bottom line is that most people should just buy an index fund. Most people should just buy an index fund and forget about it. That's it.
I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
Wrong. I am. I am, Paul. Speak for yourself. Okay? So does everybody understand the point, though? What I'm trying to say is that he's basically saying you can't time the market. On the other hand, that's exactly what he's doing by trying to pick individual stocks. Okay? So he's being a hypocrite without realizing it.
I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
Wrong. I am. I am, Paul. Speak for yourself. Okay?
I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
Wrong. I am. I am, Paul. Speak for yourself. Okay?
I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
Wrong. I am. I am, Paul. Speak for yourself. Okay?
I'm not a good market timer. Warren Buffett's not a good market timer. No one's a good market timer.
So while we're on the topic of crypto, if you're looking for a place to buy, sell, track, or trade both crypto and NFTs all in one place with fees that are up to 85% lower than the top competitors, then FTX US is there to help. They're trusted by millions of users, and what I like the most about them is that they allow you to set up an automatic recurring buy so that you can dollar cost average into the markets on a regular basis. So if you're interested, the link is down below in the description with the code GRAHAM, and you could get all the way up to $100 for signing up depending on how much you trade.